Looking at financial markets, the flow of capital is a key driver of long-term performance. And indeed, the flow reflects the preference or aversion of investors for certain asset classes. To illustrate that, let's compare two countries, Turkey and Spain, which share a common geography, the Mediterranean, but could not be so dissimilar as to their standing currently among investors. Let's start with Spain. After years of deep recession, the Spanish economy is moving into a recovery phase with a bit of growth in the second half of 2013. And a slight fall in the unemployment, admittedly from very high levels. Most impressively, the current account deficit of Spain, which peaked at minus 12% back in 2008, has turned into a small surplus in 2013. Labor market reforms has boosted Spanish competitivity, especially compared to France and Italy, where unit labor costs are still going up. Bond investors have honored such progress by driving down the yield of 10-year Spanish government bond to 3.7%, narrowing the spread with German bond to 200 basis points, compared to 600 basis points in June 2012. This is a great achievement. Obviously, the weak point remains public finance with an excessive budget deficit, but all in all, Spain has managed to regain the confidence of investors. This brings stability to the euro, and we would expect Spanish asset prices to continue to appreciate over time. Now let's move to Turkey, on the other side of the spectrum and on the other side of the Mediterranean. Turkey is increasingly facing gloomy prospects. The infighting between different branches of the government, high inflation, are undermining the confidence of citizens and investors. With a large current account deficit, like Spain a few years ago, Turkey relies on longer-term foreign direct investment and shorter-term portfolio flows. Until very recently, the central bank was reluctant to increase interest rates to provide a real return to investors, and at the same time, foreign direct investments are down sharply. On the 20th of January, in a spectacular U-turn versus its previous policy, and left with no choice, the central bank decided to increase interest rate massively to prevent a collapse of the Turkish lira, the local currency. Such a move generates huge uncertainty for the economy. Certainly, Turkey is in the process of losing its credibility versus investors. Let's have a look at global equity markets. The recent weakness across global equity market certainly is due to wobble and stress across emerging markets, like Turkey, as investors really are worried about the lack of reform and too much inflation. But the recent weakness has also to do with excessive investor sentiment. Investors were too bullish after a very strong year in 2013. But looking at the overall picture, we still have accommodative monetary policies, low inflation, an improving global economy driven by the US, and robust corporate profits, which point to favorable prospects for developed equity markets. We have been running a neutral allocation to equity for some time, but we would use weakness in markets to add selectively to our equity exposure.